So today we're talking about demystifying indexed universal life, and this is the second in a series of 5 webinars. And this one gets really interesting because this one starts to talk about how life insurance companies can afford to provide index credits. What's the secret sauce? How does this happen that life insurance companies can afford to provide this positive index crediting based upon the movement in an underlying index, but have a 0% floor. So we're going to talk about some of those aspects. A couple disclosures. So we're going to talk today about how life insurance companies provide index crediting. We're going to talk a little bit about cap and par rates, and there's, I guess, also a spread rate that we can talk about. And then we'll talk about variable interest rate loans and how a company can afford to do variable loans. And then one of the other questions that I think we typically get is, why are annuities and life insurance caps and par rates so much different? What's the difference between annuities and life insurance? So I'm going to hit on that as well. So we'll hit first on providing index crediting. And really, indexed universal life is not significantly different than fixed universal life, except that we credit interest based upon the movement of an underlying index. Everything else is really the same. And one of the things that is essentially the same is what companies invest in. Companies do not go out there generally and go out and invest directly in the market either. They're still typically investing the client's funds in bonds. High quality corporate bonds, AAA, B, those type of bonds, and sometimes a little bit of mortgages and other things here and there, but generally high quality corporate bonds. So if we're investing in bonds that are getting 4, 4.5%, 5% or whatever, how can we afford to provide all these index credits that might be 7, 8, 9, 10 or more %? Well, one of the ways that companies do this is with call options. And a call option is basically kind of like a mechanism or tool that will pay off if the underlying index that you're buying the call on moves up. So that's one of the things that companies do is they do call options. So let's dig into that just a little bit more detail on how call options work and how this is associated with indexed universal life. Call options, we're going to talk about a few things here. What happens when the index goes up? What happens when the index goes down? Buying and selling a call, and then how caps and companies work with that. I'll talk about that. There's static or dynamic hedging, and there's focus on revenue neutral type of an idea. So let's kind of hit all of these aspects. First, what happens when the index goes up? What happens when the index goes up, and this could be the Euro stocks, it could be the Dow, it could be the S&P, whatever underlying index is used. When the index goes up, the call option essentially pays off. So the company buys a call option against the underlying index, and when the index goes up 10%, they get paid essentially that 10% that they can use to then credit to the policyholder. When the index goes up 20%, they get paid, so etc. So that call option essentially starts at 0. That's kind of like the strike point where it pays off, and anything above that is paid out to the company, which it gives them the funds that they can use to then pay out to the policyholder. So what happens when the index goes down? Well, the company purchased a call option, the index goes down, the call option pays 0. So the company in turn credits 0 to the policyholder. That's kind of how the floor works. So if you think about it, the company is taking all these bond returns. Let's say that the company has a 5% portfolio rate, for example. We take that 5% portfolio rate, maybe a little bit, 0.5% or something like that off the top for profits and other costs and things. And the bulk of that bond interest is used to purchase an option. So on $1,000, if you're looking at 4.5%, you're looking at $45. That will be used to buy an option. And if the index goes up, that pays off. Good, we got money we could credit to the policyholder. If the index goes down, that $45 has been spent, that 4.5% or whatever has been spent, and in turn you get nothing. That's how indexed universal life works. But if that's the way Indexed Universal Life works, the call options, for people who are a little bit familiar with call options, they say, well, wait a minute, Tom, there's no upside on the call option. That means when the index goes up 20, 25, 30%, those pay off at those numbers. So that's true. So what a company will do is they will buy and sell a call. So we will buy call options that start at 0, and no matter how high the index goes, that will pay off. But of course, that would be very expensive to have an unlimited cap and a 0 floor. Certainly not something we can afford with a 4.5% or 5% option budget. So we need to find some way to control that cost. We can't have an unlimited. That would be under the category of too good to be true. That has the unlimited upside and the 0% floor. So in order to afford that, we have to find out, well, we need to find some area or range that we're going to work with. And that is typically the cap. So let's say the cap is at 10% or 11%. If the cap is at, let's say, 11%, we will essentially buy the option that starts at 0 and goes all the way up. And then we will sell an option with a strike point of 11, from 11 and up. So essentially, everything from 0 to 11 in that example is where the option pays off. And then from 11 and up, we have offsetting options. We have bought an option and sold an option. So essentially, that is neutral at that point. That's how the cap rates are designed and why they're in place. Now, you could also do that with participation rates or spread. You can do that with different mechanisms. The most common index selection used is a point-to-point with a cap. And that's how the cap works, and that's why the cap is set where it is. It's all about how much funds that you have in order to buy the option. If we have a little bit higher option budget, or if option costs are cheaper, maybe that cap can be a little bit higher. If we have a less option budget, or cap, or options are more expensive, we might have to go a little bit lower on that point where we buy and sell the call. So that the point of where we buy and sell the call is generally where the caps are. And I'm going to skip over this bullet here in a second because I want to go back to the bottom here. That really focuses this idea on being revenue neutral. The idea that, oh, well, companies, certainly they must make a ton of money when the index goes up 20% and they only credit 12. No, that's not typically the case, because companies typically will focus on it being revenue neutral, and they will buy options and those type of things, and try to identify a way that this is neutral to the company, that they're going to take their option budget that they've dedicated, purchase the options, set the cap at the point that it does not matter. If the index goes up 20%, they're not making extra monies. If the index goes down 20%, they're not losing extra monies. So that's the real main focus when companies are setting their cap and par rates and spread rates or whatever, is this idea to be generally neutral in pricing. Then this other bullet here is of interest, and the fourth bullet is static or dynamic hedging. And typically you will see something that the companies will typically do a type of hedging where it's either going out and buying options, but companies could also do their own type of hedging, so to speak, and maybe then the company might have a little bit of investments in the market, or may basically emulate their own options. So that's another way that companies can invest as well. But probably the best way or easiest way to explain to clients is that idea of the option budget, and how companies take bond returns, they turn that interest on bonds into an option, and the option in turn provides the funds necessary to credit. Hopefully that makes sense. So let's kind of walk through that just to really put it ingrained in our minds as to what happens. And this may help you as well better explain to clients how this can possibly work, because it sounds almost too good to be true. Index credits that you can get this positive movement and no downside risk. So let's kind of go through it again. Client pays the premium, and there may be premium loads, or there may not be, depending upon what product you have. Most of that money is invested in our bond portfolio. Again, typically most companies are 80, 90% in high or more in high quality corporate bonds. From that bond interest, life insurance companies are really good about knowing what bond interest they're going to get. They've been doing it for a long, long time. So we're pretty good with portfolio rates and knowing what bond yields we got. So we'll take that bond interest and we'll go out and purchase options. And then the options will decide how much credit based upon the movement of the underlying index. Those options will pay out, and then that will give us the funds necessary to credit the interest of the policyholder and still be revenue neutral for the company. Now, with options, it's not just necessarily, oh, well, this is how much your bond interest is. There's another element, another factor that we have to consider, and that is the price of options. That's a free market thing. We can't control that. So when you have times of high volatility, and hey, we've recently had high times of volatility here, but the option price could certainly change, and that could put additional pressure on cap and par rates because the cost of the underlying options may go up. Now that's a little bit offset in the sense that we're also selling options, so that helps that quite a bit. That we buy and sell an option, but still there is that block in the middle there where we're just buying, so to speak, and so the option price will certainly have a factor in this equation. And because there are these two factors, the factor that can both change, and they're largely free market driven. The one is the option price. We don't know what the option price will be because that's just the free market's speculative nature. And then the option budget, and that option budget is largely determined by the bond rates, the bond yields that we're getting. Now it's also determined by things such as the product design. You can have a product that has higher charges in it that may support a higher option budget. You may have a product that has low charges in it that might support a lower option budget. And that's one of the reasons why you see different products may have different caps, even within the same company, or different versions of a product may have different caps, even within the same company, because they may have changed in design, in option budget design, in policy charges, or other things. So there's a number of factors that can come into play there, but generally, the reason that we need to have some element that can change, the reason that there has to be, we can't just lock in the cap and par or spread rates throughout the life of the policy is because we can't control these two things. We can't control the bond returns. We can't control the option prices. So some element has to be able to move, and that will either be the cap or the participation rate or the spread rate. Those are the three elements, at least in North Americans products, that can possibly move. Again, the most popular index selection is usually a cap, and in that case, the cap might have to move depending upon these factors. So now let's get into a couple other areas, and one is variable rate loans. Variable rate loans are really one of the things that makes IUL really compelling. It takes an idea that you can get positive interest credited on loan funds, a positive arbitrage potential, or negative arbitrage. It could certainly go the other way. So one of the questions that we get is how can borrowed funds still participate in the underlying index? And basically what's happening here is that if you're taking a loan against the policy, the client sometimes thinks, hey, well, that's money I'm taking out of the policy, so it's no longer in the policy, right? Well, no, that's a withdrawal. If you take a withdrawal, the money's no longer in the policy and it comes out. But if you take a loan, that is not actually removing money from the policy. That's borrowing money with using the policy account value as collateral. So you're borrowing money from the policy, the account value is used as collateral to back that loan, and that's how a loan works at a company. Now, if you're borrowing money, can the money that is still in the account value be still tied to an underlying index? Sure, yeah, it could do that. So if the company is looking at it saying, well, how in the world can you possibly afford as a company to credit 6 or 7 or 8% interest, or 10 or whatever percent that the underlying index does, and only charge 4%, which is, for example, today our current variable loan rate. People may say, well, how can you afford to do that, to charge 4% and still credit 8 or 9 or 10? Sometimes we might not credit 8, 9, or 10. Sometimes we might credit 0. But essentially, all the company is concerned about is what would we do if that client's money were not borrowed out to the client? Basically, we'd be investing them in corporate bonds. And if we buy new corporate bonds today, they're getting around 4%. That's essentially very close to the Moody's corporate bond yield. So basically the idea here is that as long as the client is giving us the same amount of interest that we would get, or a similar amount of interest that we would get if we had actually gone out and bought new bonds today, then we're fine with it. So whether we have the client's funds and we allocate them to bonds and we buy bonds and get 4%, or if the client pays us a 4% variable loan, that's fine. It doesn't matter to us. Again, let's focus on that idea of revenue neutral. So it doesn't really matter if we're getting in from bonds or from loan interest. Then if that's the case, then why not let them take those funds that are being used as collateral and continue to invest them in the underlying index? So that idea of variable loans gives you the potential, and now we get into the idea of why variable loans. Because if you're being charged a 4% interest rate, and historically that the index might have an average return over 10, 20, 30, 40, 50 years of 5 or 6 or 7 or 8% or whatever, if the underlying index has this historical return of higher than the current loan rate that you're being charged, well, then that's pretty interesting, isn't it? That gives the client the possibility of positive arbitrage. Now they need to balance that into the fact that they could go negative arbitrage 1 year or more than 1 year, in the sense that they might get 0% interest and be charged a 4% or higher variable loan rate. But if the client feels that over the long run, the potential of index crediting is higher than the loan rate that they're expecting to pay, then they may find variable loans are very interesting to them. And that is one of the things that makes index universal life illustrations so attractive, is that idea that the client can potentially get a positive arbitrage. Now, with index universal life, one of the things that happens with AG 49 regulations a couple of years back is that they required that you cannot illustrate anything more than a 1% positive arbitrage. So even though our current variable loan rate is 4, if and we might be illustrating, let's say 7%, we're not, the actual funds that are backing the variable loan, we're not illustrating any more than a 1% positive arbitrage. So that even though they might actually be getting 3% positive arbitrage, we're not illustrating more than 1. So there is a little bit of built-in conservatism on the illustration software as the AG 49 regulations require. One of the other things that you should really look at or think about with variable rate loans is the idea that they should be capped. Let me go back to this idea here on why variable loans, because there is another type of loan out there that's a participating loan or a fixed participating loan, and there are some companies out there that will have a fixed participating loan, and maybe they'll be at 5% or 5.5% or 6%. Typically, they're in the 5 to 6% fixed rate range. If a company has a fixed participating loan, that's great in some sense that the loan rate can't go higher. If they're at 6, it's not going to go higher than 6. You know that that's going to be essentially the rate. That's nice. That's fine. The problem with a fixed participating loan instead of a variable loan is that you don't get to participate in the down potential of the loan interest. What happens when we're in a low interest rate environment as we are today? The loan rate may be, yes, fixed at 6% and can't go higher, but it also doesn't go lower. And so even though from an illustration standpoint, that may not significantly impact their illustration, it will be impactful in real life. Because in the illustration, they can't illustrate more than 1% positive arbitrage anyway, so they think, well, we'll have a fixed loan. A variable loan in real life could give you the potential for significantly higher arbitrage. But now let's think about that. Well, if you have a variable loan, what happens if the variable loan rate goes to 7 or 8 or 9 or 10 or higher? And there are companies out there that do not have a cap on their variable loan, or their cap is a moving cap that's essentially uncapped. One of the things that I think is important on a variable loan is to have that element of a cap, that upside limit on how high the variable loan rate can go. And in North America, our variable loan rates are capped at 6%. So although our current variable loan rate is 4%, and on our current products, it could go as low as 3.5%, the products are capped at 6%, which gives some element of safety, I guess, for the upside potential movement of the variable loan rate. And then the last item that I want to talk about, and then we'll open it up for questions for people who are on the live recording here. Annuities versus life insurance. One of the questions that I get on annuities is, especially from an agent who's familiar with annuities, they'll say, well, wait a minute, how come the annuity cap rates are so much lower than the life insurance cap rates? And they'll ask, what's going on there? How come they need to be designed so differently? Annuities have all these other things going on with them. What's really the difference going on here? And is life insurance basically going to be the same as annuities in terms of cap rates? There's a couple factors here to consider. One is the bond portfolio perspective. And I think there's some things to think about in the bond portfolio perspective, and that is that annuities are very largely a transactional item. It's a bunch of money in and out. It's very very focused on pure the finance aspect of it and then the cost of today. You can turn on or off annuities by just moving the smallest of amounts, and because annuities are so focused on the actual rate of today, they need to be designed on a new money type of perspective. First of all, they also buy a little bit shorter bonds probably than life insurance, and generally life insurance, the longer bond duration might give you a little bit better return. Not a lot, but a little bit better return, because life insurance is long-term focused. Annuities are transactional. But I think the most important thing on that bond portfolio perspective is that that the annuity companies need to use a new money rate, and life insurance companies can use more of a portfolio rate. And a new money rate means what's the current rate of today. And there may be some life insurance products that use a new money rate if they are focused on large lump sum type of sales. That would be a product that would probably be focused more on a new money rate. And then and annuities, of course, are generally new money type of products. Life insurance products are typically designed for long duration, oftentimes designed for level pays throughout the life of the policy. And because of that, life insurance companies often use what's called a portfolio rate, which is essentially their average return over their entire bond portfolio. So even though new money rates may be around 4%, that's the rate that a company can get on their bond portfolio. I'm on new bonds that they purchased today. Their portfolio rate on a life insurance company might be 4.5%, 5%, or 5.5%, because that includes bonds that were bought 5, 10, 15, 20 years ago. So a portfolio rate is slow to change, takes a long time to move. It's like a slow, an ocean liner. It just takes a long time to turn it. Type of thing. So that's one of the advantages or disadvantages of a portfolio rate on life insurance. They're very stable. They're slower to move than annuities. Annuities can be much quicker responsive, which means that if the bond rates fall very quickly, annuity rates will fall very quickly. And on the flip side, though, if bond rates go up, annuities can perhaps respond a little bit quicker than life insurance. In the low interest rate environment we're in today, annuities are typically quite a bit below the portfolio rate of life insurance. And that's one of the reasons why the annuity caps and par rates are lower than life insurance rates. But the second reason that annuity caps are typically lower than life insurance is because of the option budget. And by option budget, I mean, how much money does the company have to spend on options? We already realize that options are kind of the way they can afford to provide index credits. So how much money can they afford to spend on these options? Well, if they're investing in bonds, we already talked about the idea of portfolio rates versus new money rates, and there's some difference there. But there's also the idea of how a company can meet their costs and meet their profitability levels and things, and keep the lights on and things of that nature. So annuities can really only operate essentially in one way, on a spread. They get their interest. They have to take money off the top, maybe 1.5% off the top to cover their charges and other costs and fees and expenses, and the rest of it they have to work with, and they can buy options. A life insurance company has other things they can do in a product. They have additional charges, they have fees, they can do all sorts of other ways to recoup some of their costs and charges in a life product. And because of that, generally, the life insurance product does not have to take as much spread. So if you combine those two, if you say, well, if the annuities are working, and this is just kind of theoretical, but it kind of points out the idea. If annuities are working with a 4%, new money rate, and life insurance companies are working with 5.5%, and then annuities have to take maybe 1.5 points off the top for their costs and expenses and fees, they've got 2.5% left of their bond returns to buy options with. Life insurance company may have 5.5% or 5.5%, and then they have a smaller spread, maybe 3/4 point or 0.5 point or something like that to work with. Maybe they've got 4.75% left over to buy options with, and 4.75% is going to get you a lot more in options and in turn caps than you can get with 1.5 or 2.5% or whatever on annuities. So that's the reason why annuities and life are different. From a portfolio rate, could portfolio rates eventually get to the new money rates? They could. If we stay at the rates that we are at eventually today, yes, portfolio rates could continue to climb. Or on the flip side, the annuity portfolio rates could rise very quickly. If corporate bond rates rise by 1.5%, then annuities, new money rates, and the life insurance portfolio rates might be around the same. But then we still have the different spreads that we have to work with. So there's still that element of it as well. So basically, you're going to have to see annuities portfolio rates probably rise to a percent. The new money rates probably rise to maybe 1% or more higher than the portfolio rates of life insurance companies before we start seeing them become more comparable. But in terms of what's going on today, that's why they're so different. A lot of detail there. So in summary, I wanted to summarize what we talked about here. We talked a little bit about how life insurance companies can afford to do this, how they can afford to credit on the upside and have the downside floor. And essentially that's with investing in bonds and buying options. We talked about the cap and the participation rates, why we have to have some sort of controlling element for the unknown, the things that we can't control. We talked about variable loans and how variable loans can afford to provide index credits and possibly get the positive arbitrage. And then we talked a little bit about the difference between annuities and life from why they're so different.